Good to see you, President Malpass. Welcome.
Hello, Sarah. Good to see you.
Joining us on a down day where the concern yet again is about the Fed and just how aggressive it's going to be. We got another pretty decent jobs report today, 3.5% unemployment, not too shabby. Do you think there's a big risk here of the Fed overdoing it on raising interest rates?
I think there are a number of problems. One is the oil prices keep going up. You know, there are the problems in the bond market. As the short-term rates go up, then the bond market feels that, and then there are margin calls, so that all circles around. And we have overhanging the worry about growth, including in 2023. I think one of the concerns for us, for the World Bank and for development, is this sense that the trends that are happening right now may continue into 2023. That means concerns about inflation, but also about the rate hikes that you mentioned. The central banks are maybe behind the curve, clearly with inflation going up and being persistent. And I think they have to use all of their tools. Same thing on the oil prices. The world has to be using all of its tools in order to change the direction.
Well, it's what the Fed has been doing, right? I think now the question is whether they're doing too much or whether they're about to do too much. I know you've been watching the spillover effects in places like emerging markets for the rest of the world. It's got to be a concern.
Well, they have to deal with the inflation problem, and you're right. They're using all of their interest rate hike tool, but I think they have other tools as well. There's the financial regulatory policy, and this applies to the ECB and the Bank of Japan. You know, the global central banks are all in somewhat similar circumstances of high inflation that's stubbornly high. And very importantly, I think there has to be a focus on how the monetary policy and fiscal policies can help on the production side. The world needs more goods being produced and more services being produced, and especially in the U.S., there needs to be more productivity, more workers, but also more output in order to meet the gap in world supply.
You know, the other byproduct of all of this Fed hiking is that the U.S. dollar continues to make new highs. It's strong again today, up another 0.5%, which is wreaking havoc on earnings from technology to pharmaceuticals to healthcare, any business here that does business abroad, basically. You've watched the global impact of this. Is it getting too strong for comfort, where you'd like to see maybe some type of action to fight it?
Well, I'd phrase it a little differently. The weakness of the other currencies puts pressure on U.S. earnings, but it also puts pressure on the fiscal policies for other countries. As if they have debt that's dollar debt, which many of the developing countries do, it is really ratcheting up the pressure on them. Not only are the global markets, bond markets, closed to them, but the interest rates on their past debt are going up. You know, we saw this a little bit in the late 1990s as the dollar got stronger and stronger. The pressure built up in bond markets, in global currencies, and there was currency depreciation and devaluations in countries. I think, of course, this time is different, but we also see the pressure on debt service. I put out, we're observing. For 2022, it looks like the poorest countries in the world, 75 poorest countries, the IDA countries, will have to pay $44 billion in debt service, or that's what they're being expected to pay by world markets. That's just a very difficult situation because the dollar is so strong.